Um, we've gone through the prior charts. I've shown you where the unemployment rate or the percentage of the population that's that's employed is. You have to go all the way back to 1978 for it to be as bad as it is now. You saw where the registration of new automobiles in the county tag offices across the United States are at the 2009 lows during the height of the crisis. You saw where more people right now are receiving food stamps than at any other time in American history, or maybe to back to the Great Depression at least. So things are not getting better, they're getting worse. The regulators, the central banks across the globe know this, and they're quietly taking various measures so when it hits again that it will be the depositors of these individual institutions, they'll be the ones to take the quote unquote. So these little phrases that they use, from green shoots to haircut to Goldilocks economy to the Great Rotation, things like this just, God, it's like a pebble in your shoe. They just bug you to death. Let's level with the people and call a spade a spade. I mean, these haircuts, it's theft. It's nothing short of theft. Just like if I showed up at your door and I had a gun in my hand and I said, "Give me all your money." Well, that's theft, you know. So, anyways, the political correctness sometimes just it drives me nuts. All right, so moving on. Um, in March of 2003, I read a book called Conquer the Crash. You'll see here it's on Amazon. The author, his name is Robert Prechter, and he's a member of the Mensa Society, which is the Society of Geniuses. And in one of those chapters, he talked about banks. And particular part that stood out in my memory and that I'm going to show you here right quick is why do banks fail. So shockingly, you will see here why do banks fail. For nearly 200 years, the courts have sanctioned an interpretation of the term deposits to mean not funds that you deliver for safekeeping, but a loan to your bank. Your bank balance then is an IOU from you to the bank, even though there is no loan contract and no required interest payment. Thus, legally speaking, you have a claim on your money deposited in the bank. But practically speaking, you have a claim only on the loans that the bank makes with your money. If a large portion of these loans is tied up or becomes worthless, your money claim is compromised. A bank failure simply means that a bank has reneged on its promise to pay you back. The bottom line is that your money is only as safe as the bank's loans. In boom times, the banks become imprudent and lend to almost anyone. Sound familiar? In bust, they can't get much of that money back due to widespread defaults. If the bank's portfolios collapse in value, say like those of the savings and loan institutions in the U.S. in the late 1980s and early 1990s, the bank is broke and its depositor savings are gone. The U.S. government's Federal Deposit Insurance Corporation, also the FDIC, guarantee just makes things far worse for two reasons. First, it removes a major motivation for the banks to be conservative with your money. Depositors feel safe, so who cares what's going on behind closed doors? Second, did you know that most of the FDIC's money comes from other banks? This funding scheme makes prudent banks pay to save the imprudent ones, imparting weak banks' frailty to the strong ones. When the FDIC rescues weak banks by charging healthier ones higher premiums, overall bank deposits are depleted, causing the net to loan deposit ratio to rise. This result in turn means that in times of bank stress, it will take a progressively smaller percentage of depositors to cause a unmanageable bank runs. And by the way, these bank runs right now are going on down in Brazil, which you probably have not heard anything about from our mainstream media. Let's continue. If the banks collapse in great enough quantity, the FDIC will be unable to rescue them all, and the more it charges surviving banks in premiums, the more banks will be in danger. Thus, this form of insurance compromises the entire system. Ultimately, the federal government guarantees the FDIC deposit insurance, which sounds like a sure thing. But if tax receipts fall, the government will be hard pressed to save a large number of banks with its own diminishing supply of capital. The FDIC calls its sticker a symbol of confidence, and that's exactly what it is. So what he's saying here is the FDIC is just a confidence game. It is lulling the masses into a false sense of security. So what happens when we deposit $10,000 in a savings account? The bank is going to loan out $9,500 of that $10,000. They're going to pay us 0.5% interest. They're going to loan that out at 6.5% interest on automobiles or construction loans or equipment loans. Now, the sooner the bank loans that money out, the sooner they make the spread or the difference. In other words, they're paying us 0.5%. They're charging the borrower 6.5%, so the bank is going to make that 6% difference. And to be exact, the bank didn't do anything to earn that money, so it's an infinite return to them. Okay, so let's keep going here. Here you will see panicked Europeans rush to ATMs as leaders seize funds directly from bank account holders. Okay, so over in Cyprus, which is in the Mediterranean near Greece, the banks became insolvent. And what had happened in prior years, going back to 07, 08, were bailouts, where more or less all of the taxpayers were their funds or all of the liabilities were put on the taxpayers' back. What is going on in Cyprus now is, let's say that you have a bank that runs into trouble. They are stepping in and they're seizing the assets of those depositors. This is the modern day bail-in. And again, I mean, this is nothing short of an outrage. So let me give you an example of what we're talking about here. This is the Laiki Bank, a major bank over in Cyprus. And prior to the middle of March, there was a family who had a bank balance of 849,000 euros. The Cyprus government stepped in and they blocked funds. They have blocked funds now on this account of 720,000 euros, thus leaving the depositor available balance only 128,000 euros. So I would say, let's say that this person is in their mid to late 60s. They went to bed a millionaire. Now you say, well, wait a minute, Bob, a millionaire, what do you mean? That's 849,000 euros. Well, when you convert those to American dollars, the exchange rate right now is about 1.3. So you'll see that their bank balance was roughly $1.1 to $1.2 million. And what they were left with after the Cyprus government got through seizing these assets was only 128,000. So you can see this is, I mean, it makes me nervous sitting here just looking at this and fathoming the emotions that this individual or this family had to have experienced with having this taken place. So there was a former head of the FDIC. It's a lady by the name of Sheila Bair. She said here off Money News website, "We still haven't lowered the boom on big banks." Let's read this first paragraph here. Former U.S. banking regulator Sheila Bair, a champion of forcing big bank breakups, which is not true, by the way, um, used a self-interview on Vox to attest that protecting taxpayers from the reckless behavior of the financial behemoths is far from completed. So she is no longer at the FDIC, and in a moment of truth, she's more or less trying to get the word out that these big banks, not only in the United States but all across the globe, are in big trouble. And she is somewhat trying to wash her hands of the responsibility of the role that she played in years past. So, I'm not a financial advisor. I cannot give you financial advice. What I can do is tell you what I've done myself. I am as far out of the system as possible. I've got just enough money in my business account to pay my operating expenses. I have cashed out of all equities. I paid the taxes on my retirement account years ago, because you and I both know, whether it's 5 years from now, 10 years from now, 15 years from now, or 25 years from now, taxes are going up. And so I paid the tax liability and got it over with, and I've closed out the account. And like I had told you in the past, all of the assets that I have, which is not as much as I'd like for it to be, are in precious metals. Since the year 2000, I'm sure many of you out there are familiar with the guy Jim Rogers. He's from South Alabama, a really good guy. He's often on CNBC and Bloomberg. He wears a bow tie. He's a multi-billionaire, and he regularly has talked about how since the year 2000 we've been in a bull market for commodities, for hard assets, whether that's silver and gold, whether that's farmland, whether that's oil, commodities in general. They're all up and up significantly. So we are experiencing right now, or going to start experiencing, what I believe to be whiffs of deflation, where there's a good chance the equity markets are topping out. And when they do, despite what Bernanke says about tapering, another little talking point that, much like the others, there's not going to be any tapering. The only thing they know how to do is print money. The example that I gave you in a prior broadcast is my grandmother in the year 2000 was sitting on $100,000 in a savings account. At that time, a barrel of oil was less than $15 and gasoline was less than $1 per gallon. Here we sit 13 years later. Gasoline is at $95 or $96 or a barrel, and what we're paying at the pump right now is around $3.40 to $3.50 a gallon. So you can see they've massively devalued her purchasing power. And the way they've done that is through all the money printing that has gone on. And not only are they devaluing the savings of my grandmother, but of course they're doing it to you and they're doing it to me. So to wrap up here, you'll see, of course, the services that we're offering: insurance, precious metals, legal services, accounting services, firearms, gun safes, banking, or home security systems. If you have any questions, of course, you can call us 770-271-1074, and our email address, bob@assetprospecialists.com. Again, this is for informational purposes only, and before investing, seek investment advice. Take care.